The risks of investing in oil and gas deals. As with all investments, there are risks, but we are also mitigating them, which is on the next slide. So the most straightforward risk here is just the volatility of oil. Over the last 5 years, we've seen it go anywhere as low as less than $0 during COVID to as high as $120 a barrel or something when the Ukraine-Russia war first broke out. And so uncertain commodity prices lead to uncertain returns. And it's a double whammy effect because if prices go down a lot, not only does that decrease your return from that angle, but operators also reduce how much they're producing. So that also brings down your returns. Next, there is no assurance that oil and gas will be found, or that if it is found, it will be in a quality or quantity that's sufficing for commercial production. Although we do try to minimize that with the geological studies. And next is delays in drilling and operations that we just discussed. We don't know when these companies are going to drill or distribute. We have a good estimate, but we don't control the operators. They are their own entities, their own companies. And then lastly, monthly operating costs could exceed monthly production, and that would occur if oil prices drop too low, like it did during COVID. That being said, with all these risks, we're obviously being smart as investors, and here's how we're mitigating it. So our returns are modeled at $70 a barrel of oil, and that's the average price over the last 5 years, including the period of time where oil was negative during COVID. So that's one. And as this demand deficit continues to grow, we expect the price of oil to grow too, but just being conservative, we always want to underpromise and overdeliver. We're not accounting for that. Second is the break-even price for this project is $37. So if we want to cover all of our expenses, that's how much we need to be selling oil at. And on a per gallon basis, that's less than $1. So I don't think that's happening anytime soon. I'm sure we all wish it would as a consumer, but as an investor, it isn't. Next is conservative estimates on the estimated ultimate recovery, the EUR, how much we think these wells are going to produce. We are going to undershoot that just to be safe. Next is the diversification across 8 wells. So even if one goes dry, which is pretty slim chance, as Courtney mentioned, 6 out of 1,100, there are 7 other wells that can make up for it. We're also diversifying across 2 operators, the 2 companies we're investing with, Coda and Slauson, and in 3 different locations. We also have correct me if I'm wrong, Courtney, but a 10% contingency reserve in case expenses outweigh revenue in certain months, like we mentioned during COVID. But just for historical reference, over the last 17 years that DW has been operational, it's never done a capital call. And even if it had to, it pales in comparison to a real estate capital call. Here, every $100,000 invested, it might be a couple $1,000s at worst that the capital
That's
call could be.
worst case scenario. It's probably closer to $500 because we were probably still producing, which will cover some of those costs. You're probably talking somewhere in the $500 to $1,000 range. So it's much, much less significant. But like you said, DW's never had to pass that on before.
Yeah. And lastly, to round it out, who we work with, right? The operators have a lot more skin in the game than we do. We have 3 to 6% little league interests. They have the lion's share of the equity in these projects. Compare that to real estate, where investors typically have anywhere as high as 30, 40% where they're contributing capital. Here, we are, again, like Courtney said, just riding their coattails to success. And also that comes with working with obviously the right companies who are reputable, who keep their lease operating expenses, LOEs in line, and just run a very tight ship.